Okay, so this is going to be the Coke trade that I'm looking at. I'm going to start with the indices really quickly, and then we're going to go into why I like Coke short. So quickly, we had obviously quite the drawdown in the indices in late March into early April. Um, I was thinking that this price was probably going to reaccumulate and then head for new highs, but that's not really happening. What I'm seeing is prices yet to retest this low back here, and we're kind of making a new range, basically retesting previous lows. So I think this is likely redistributing. I don't think this is ready at all whatsoever to go higher. I think this could definitely squeeze higher and then introduce new sellers, but I think this is likely redistributing for new lows before any new highs are coming. So a few things are pointing towards that, a little bit on the VPA side, but main thing is we've kind of just, we had that massive spread candle on Wednesday, April 9th when tariffs were paused. Not a huge amount of volume for how large of a candle this is. I mean, this is by far and none the largest candle on the screen out of the past, I don't know, maybe even 3 years. So, I mean, given it was like what, an 8% day on the indices, a 13% swing from the lows on the indices without an insane amount of volume. Some random day back in March 4th had more volume than a 13% swing. So I think that was a little bit of manipulation just to get price back to highs where sellers can continue to selling at advantageous prices to sellers. Selling it at a high price while kind of inducing new bulls before this reaches new lows. So with that being said, I do like KO for a shorts. Going to be breaking down specifically KO right here. Just on I guess we'll start with a range perspective. There's a few things that I look for that differentiate between reaccumulation and redistribution. So in one scenario, reaccumulation is off the back of a move higher. Excuse me, this would actually be distribution. This is not redistribution. Redistribution would be what price is currently doing on the indices. You have the move down, you have the move down, down, redistribute, down, redistribute, down, something like that. Whereas in the KO scenario, I think it's distributing versus redistributing or reaccumulating. So I'll say it just for absolute clarity. This is, in my opinion, distributing versus reaccumulation. So instead of going from 61, reaccumulating within 60 to 75 and going higher, I think it's going to be doing the opposite. I think it's making its push from 63 up to the highs at like 75, and then I think this is going to fail. Why do I say that? I say that for a few reasons. Typically, when we see any kind of redistribution, we'd like to see whenever we see a reaccumulation, we'd like to see a decreasing volume throughout the range. Why do we want to see a decreasing volume? Is because institutions are essentially mopping up available shares on the market, and we want to see volume contracting, and we want to see volatility also contracting. We want to see price staying within the range and volume subsequently falling. Whereas in a distribution range, we would tend to see the opposite. You see the large increase in volume to push price into the new range, discover new participants within this range, and instead of seeing a subsequent decrease in volume as price is contracting or trading within this range, we see massive volume spikes throughout. So that's usually a big teller of distribution versus reaccumulation or accumulation. So that's one large player as to why I like KO short. Second player is I think this is very late stage, very, very, very late stage distribution. Why do I say that? Just to go through the phases. So you have phase A, which is the stop of the prior trend. So price obviously made a very nice run up on KO from 60 to about 72. You saw that large upper wick. Price then kind of had that rubber band reaction down to 68 after making that pretty crazy move to the upside. And then it's been trading within this range. And then we do see a UT, what looks like a UT, which means an up thrust. So it's kind of like an upper wick to just not show strength on the seller side, but just kind of another test and rejection of a previous high. So that likely traps some buyers long. Price re-enters the range. Very drastic reaction. You see the big gap down. Price is able to hold the bottom of the range, and then price is trading all the way back up to the top of the range. So then we see what's likely it looks like the up thrust into what looks to be the phase C actually reaction. So this was phase A, creating the climax event. You know, we had that climactic move from 60 to 72. Climactic event, it gets that snapback down to 68, and then it's been trading within 68 to 73 since February 25-ish. But the big thing with this event right here in this green bubble, it really should be a false breakout, so it should be red. This is where buyers were able to push it past even this upper wick, and then sellers were able to force it right back down. So that usually creates an imbalance between buyers and sellers. It's the same thing that we look for in a spring. A spring would be to the upside. In this case, where so I had flipped it, but we'll do it from how it actually is. So you get the entrance of new buyers who are seeing KOs breaking previous highs, breaking the range. New buyers are entering, and then new buyers are entering, and then sellers, people who were in good sell positions that correctly identify this is a distributive range, likely having to close, so they're rebuying their positions. So you have new buyers entering long, you have sellers who were in good sell positions who are now buying to cover their shares, while institutions are doing the exact opposite and they're selling the shit out of this. So what happens with this is it creates a very big imbalance between buyers and sellers, where you have that false breakout. And then when price re-enters that zone, you're going to have those long buyers who are now forced to liquidate. You have the sellers who are getting back in now, selling just now that they've seen price re-enter the range. So it's a very big, it really denotes control. We always trade in the direction of the most recent false breakout. So I would argue that I would have been long down here if I had been watching KO, just because we had the false breakout to the downside. We likely introduce new sellers down here, which they were then forced to cover as price re-entered the range, and the new buyers seeing that previous support's holding, and there's no wonder that price made it all the way back to the top of the range. So I do really like that price broke out above 73.24, which is the top of the range, and then it's had a pretty nice little distribution going on within here before I think it's going to absolutely tank to the downside. So I'm going to bring up a few schematics, just what I have in notes, and kind of show what I'm kind of talking about here. And redistribution. So it's kind of the same example, but bear with me here. This is redistribution. Price has had its distributive range, and then it broke down, and then it redistributed before heading down farther. In my opinion, I think we're somewhere around here on KO. So this is the UT. So the UT is kind of what I highlighted in that first attempt. It's the first, kind of test of buyers and show of strength for sellers, as sellers were able to push this all the way from, the false breakout. I mean, from the false breakout in the upper wick all the way down to that large gap down. I mean, that's a very nice sign of strength on sellers if they're able to push it, 10.65% within 4 or 5 4-hour candles. So, so that's your UT, and then you have your UTAD, which is, whether we're there or not yet, I'm not quite sure. Now, every structure is different because there's always going to be different participants in the market. But if we're saying this is our UT, this could be a potential test right here on, Wednesday the 23rd, or we could still be getting it. I'm not really quite sure, but I think this looks really good from a downside perspective, especially with price trading lower below the EMAs now, making this very nice trap structure. You had the 4-hour exhaustive extension that actually even closed above. Now, obviously, with the wicks, we can see that price had managed to get above the top of this range before. But with this close, you can really see this false breakout where we had that entrance of new buyers likely with this breakout above the range, and then it came right back, snap back, retest it, and then it's down. So what I'm expecting is KO to fall through the roof, kind of like a few names, like I think Pep has done. Um, no, maybe it was Procter and Gamble or something like that. Not great examples. I don't remember off the top of my head, but there's a few names in discretionary or no. Am I wrong? There's a few names in not discretionary consumer staples that looked pretty bad. It might have been no, not quite sure. Anyway, I think KO. What I expect for this trade is it to make its like final last point of supply before it eventually tanks back through, probably retest the bottom of the range. And then what I'm looking for is aiming for June contracts, and there's a few gaps here that I'm targeting lower. So the first gap is going to be 64.50. You can kind of see there's a gap from the last earnings gap. I think I would like price to close through there. It's going to move pretty quick when this does break down from the range, and I do think it is going to. Second gap, if we're getting greedy, would be down here at about 62. Another previous gap that was left unfilled throughout here. So those would be my targets into June for KO. Now, if we go take a look at the options profit calculator, I have been looking at the June 20th 65 put. It does seem pretty outside the money, but where I think we're going in this distributive range, I think 65 is pretty fair, especially being that it's kind of the middle of the gap. I wouldn't say middle of the gap, probably lower end of the gap, but I think it's a fair target to go for. So I think it's going for around $50 right now, so I'd probably put on somewhere around 100 contracts, just given I've been rocking about $4,000 to $5,000 positions within my account, so it's a little on the higher end, but I'd say this is probably close to an A+ trade on KO, given where the market is and given where, this is a very nice distributive structure. Volume characteristics are there, false breakouts there, A+ risk. Obviously, we have earnings coming up, but I think it's a really good environment for it. So even a move down to the bottom of the gap, if we were talking about it, 64.56, if we aim for the bottom of the gap, it's going to be around 300% or so gain. So if we get real greedy and we target 62 by June, I think it's going to be, it's an A+ trade if we're targeting 64, to be honest. But, anything in the 62s is going to be about a 600% gain on each contract. So obviously, I won't be holding full size for that 600% gain, but you get the idea. I think the risk to reward is there. I think even if this ahead of earnings, I would like to see this maybe even push up Monday. I'd rather see this push up into earnings versus keep tanking into earnings. But yeah, I think this goes wrong on a retest and close above 74. Now, I think 74 is a pretty good target that I'd be able to, let's say this is wrong. Let's say I'm wrong in this. I don't think I'm wrong with the distributive angle. I'd be more wrong in the timing sense. I think this is the UTAD and that this is going to knife through. I especially like the increase in volume on this very bearish candle. We tried to sweep previous support, but we weren't able to close below. So, I do really like the volume on this candle. So, by June, I think I think it'd be very rational that even if this does beat on earnings, and I think it'd be very rational for this at least to come back and retest 74 eventually. So any close above 74 would be about a 50% loss, which I'm comfortable taking. And then about, fairly 58% loss. I think it'd be more likely that 73, so what's nice is I don't think the implied volatility, I think implied volatility is sitting about 20% on these KO contracts. Let's just go take a peek. These KO contracts are rocking like 23% implied, 24% implied volatility. So there's not going to be a huge IV pop if, earnings do beat. So no IV crush to potentially watch out for, in my opinion. So really think this trade's looking nice. I think this is probably an A+ trade. It feels nice having a good trade on the docket. And yeah, that's kind of the breakdown of what I'm seeing on KO. targeting lower gap fill at 62. More conservative targets probably 64.50 gap fill off of previous earnings on Feb 10th, 25.